Okay, let's unpack this. Today, we're taking a deep dive into Tata Steel, specifically their recent performance and what's looking like their future path.
Yeah, based on those investor updates they put out.
Exactly. It's not just, crunching the numbers. It feels like we're watching some pretty big shifts in a real giant of the steel world. So what did this last quarter really tell us? And maybe more importantly, what signals are they sending for what's next?
Well, what's really fascinating, I think, is seeing a company this size try to juggle the immediate financials, the quarter-to-quarter stuff, with these huge long-term goals.
Yeah.
Especially around things like sustainability and future growth. We'll try and connect those dots.
Okay, good. So let's start with the basics. What did they actually tell investors back on July 30th about the quarter ending June 30th, 2025?
All right, so the core of it was this investor presentation.
Yeah.
It laid out the financial results, sure, but also their big strategic commitments. They painted this, multifaceted picture. Leadership and sustainability, being number one in India, pushing tech and digital, becoming a global cost leader, and critically, keeping a really strong eye on financial health, making sure they're, future ready.
And I noticed they highlighted community impact, too. That felt a bit different for this kind of update.
It did, yeah. And that's not just window dressing, I don't think. They mentioned impacting over 1.6 million lives, 16.3 lakh, as they say in India, and spending, over 21 billion rupees?
Yeah.
That's quite a bit, maybe $250 million US dollars over the last 5 years on community work, plus aligning 68 targets with 15 UN Sustainable Development Goals.
Wow.
It shows this broader commitment, right, beyond just the profit and loss. It's about that social license to operate, which is getting so important for heavy industry.
Yeah, absolutely. Okay, let's pivot to decarbonization. Huge topic everywhere, especially steel. Tata Steel seems to have a major goal there, particularly for the UK. What's the plan?
Well, this really gets to the heart of the challenge for these industries, doesn't it?
Yeah.
How do you make that shift? Tata Steel's aiming for net zero by 2045. And a really key piece of that puzzle is shifting their UK operations to electric arc furnaces, EAFs, using scrap steel.
Right, the EAFs. Much cleaner process.
Massively. Instead of coal-fired blast furnaces, you're using electricity to melt down recycled steel. The projection is cutting CO2 from about 2 tons per ton of crude steel, all the way down to maybe 0.4 tons. Huge difference.
That is a huge reduction, but is it actually happening? Is there real movement on this in the UK?
Oh yeah, definitely moving beyond just plans. They signed a grant funding agreement with the UK government back in September 2024 to help make it happen. Planning permission for the EAF secured. They even had a groundbreaking ceremony this July 2025.
Okay, so boots on the ground.
Exactly. And it's not just about the environment, though, that's critical. It's also designed to make the UK business more profitable in the long run, more efficient, less carbon cost exposure.
Makes sense. Now, staying in the UK, besides the EAFs, there's also restructuring going on, right? Any updates on those savings targets they talked about?
Yes, the restructuring is progressing. They mentioned 400 employees exited in Q1. The full financial kick from that is expected more in the second half of this fiscal year, FY26. But that £200 million savings target, still very much the goal.
Okay.
And you forget the EAF switch itself should bring cost savings too, somewhere between 150 and 250 pounds per ton. That comes from using local scrap, maybe better power deals, regulatory incentives. It all adds up.
Right, sort of a two-pronged approach to getting costs down there. Okay, let's hop over to India. What are the big moves there on emissions and growth?
India is a different picture, but equally ambitious. They're targeting a 35-40% cut in emissions intensity. Part of that is looking at really cutting-edge tech like Hizarna and EasyMelt. Yeah. These are potential game changers for low-carbon steel.
Still experimental or?
Getting there. Plus, the more conventional stuff, using less coal, making existing plants run smarter. And they launched India's first carbon bank, which is an interesting move to try and build that carbon credit market.
And capacity. Are they building more in India? Demand seems strong there.
Oh, absolutely. They're scaling up significantly. Kalinganagar's big 5 million ton per year expansion is moving fast. Yeah. The blast furnace, coke ovens, major parts are already running. Casting number 3 is due online next month, September 2025.
Okay, soon.
And then further out, there's the Ludhiana facility, smaller at 0.75 million tons, planned for FY27. Clearly betting on Indian growth.
All these big plans, EAFs, expansions must put a huge focus on cost control, right? Tell us about this cost transformation program.
Yeah, this is where it gets really interesting financially. It kicked off this big cost-saving pushback in FY24. And now, in Q1 FY26, it's really starting to show results. and they expect it to boost margins even more going forward.
How much are we talking?
The target is massive. Across all regions, they're aiming for 11,500 crore rupees in total savings. That's about 1.3 billion US dollars?
Wow.
And just in Q1, this first quarter of FY26, they delivered savings of around 2,900 crore rupees spread across India, the UK, and the Netherlands. So it's having a real measurable impact already.
That's a serious chunk of change for one quarter. They also made a small acquisition recently, didn't they? Something about power.
Yeah, exactly. TP Adarsh Limited. They approved taking a 26% stake, up to 6 crore rupees, so relatively small deal value-wise. But strategically, it's about optimizing power costs and hitting those green goals. The idea is to use cost-effective solar power instead of grid power. TPL is part of Tata Power Renewable Energy. It's a new company actually set up late 2023, hasn't started operations yet, but it shows that focus on green energy and cost cutting together.
Got it. Okay, let's get into the actual Q1 numbers then. What was the headline financial story?
Well, the headline's kind of interesting. Volumes were actually down a bit.
Oh.
Yeah, mainly because of planned shutdowns, like relining a big blast furnace in Jamshedpur. But despite that lower volume, their consolidated financial performance was strong. Profitability and margins definitely improved.
So less steel sold, but more profit made. How does that work?
Exactly. It highlights that cost efficiency we were just talking about. So revenue from operations was down year on year and quarter on quarter about 53,178 crore rupees. But, and this is key, their total spending also dropped significantly. Better cost management.
Oh, okay.
That drove their EBITDA earnings before interest, taxes, depreciation, amortization up to 7,480 crore rupees. That's up 10% year on year, 11% quarter on quarter. And the EBITDA margin itself improved quite a bit, hitting 14% in Q1.
And the bottom line, net profit.
Yeah, net profit saw a really big jump. It came in at 2,007 crore rupees for the quarter. That's up a huge 116.5% compared to last year's Q1 and almost 60% up from the previous quarter.
Wow, okay.
Really shows the power of those cost savings kicking in. Other income was minor. Finance costs were around 1,852 crore. Some exceptional items for employee separation, but overall a strong profit story despite the revenue dip.
Okay, looking ahead then, what's the forecast for Q2, the current quarter? Any headwinds or tailwinds?
Well, the expectation is that Indian realizations, the price they get per ton, might soften a bit, maybe by 2,000 rupees per ton in Q2. But the thinking is that could be offset, or at least cushioned, by demand picking up after the monsoon season and heading into the festive period. And critically, coking coal prices, a huge cost input for steelmakers, are expected to fall globally. That should definitely help margins.
Right. Lower input costs are always welcome. And volume-wise in India, what's the outlook?
Domestically, they expect volume growth to be pretty solid. That Kalinganagar ramp-up is key, targeting 6.7 to 6.8 million tons this year, plus the new mills in Ludhiana and Jamshedpur contributing. Management's guiding for an overall volume increase of maybe 1.5 to 1.6 million tons for the full year, FY26. And that's even accounting for the output lost from that blast furnace reline.
Okay, good context. Let's talk debt. Always important for a capital-intensive business like steel. How's their debt situation looking as of Q1?
Right, so net debt was around 84,835 crore rupees. Gross debt a bit higher, 98,953 crore. That's a slight tick up from the end of FY25. The key ratio, net debt to EBITDA, was 3.21 times. Pretty stable compared to the previous year.
How does that compare historically or to peers?
Well, it was lower back in FY22, FY23. But looking forward, the projected enterprise value to EBITDA for FY27 is around 6.6 times, which is generally seen as, quite competitive. A couple of other metrics. Debt service coverage ratio improved slightly in Q1 to 0.98, though the interest service coverage ratio dipped a bit to 1.69.
So what does all that mean in terms of how they're managing their finances? What's the strategy?
It shows management is really focused on optimizing things. They're actively trying to onshore their debt, move it to India, basically.
Why do that?
Potentially better interest rates, maybe more favorable local conditions. It's about efficiency. They seem confident about managing liquidity, especially for the European side. And fundamentally, that stronger EBITDA and net profit from the cost savings directly helps their ability to handle the debt.
Right.
Plus, the money they're spending, the capital expenditure on things like Kalinganagar, is seen as a way to trigger a re-rating of the stock, meaning the market potentially values the company higher because of these growth investments.
Okay, that leads nicely into valuation and projections. What are the forecasts suggesting for earnings?
The projections show a pretty strong turnaround in earnings per share. They actually had a loss in FY24. But the forecast is for positive 10.7 rupees per share in FY26, growing to 12.3 rupees in FY27.
And the price-to-earnings ratio?
That's expected to look a lot better, too, dropping from a high 63.5 times in FY25 down to a more reasonable 13.2 times by FY27 based on those estimates.
So how is the market viewing the stock right now based on those forward numbers?
Well, it's trading around 13 times those FY27 estimated earnings. And as we mentioned, about 6.6 times on an EV to EBITDA basis for FY27, which, yeah, is considered quite good in the sector. Other things like book value per share, dividend yield also showing positive projected trends.
Okay, so a potentially improving picture there. But every company faces risks. What are the main clouds on the horizon for Tata Steel?
Definitely risks. Short term, there's volatility. Those volume pressures we saw in Q1 and the softening realizations, the prices they get. Global steel prices did ease off between April and June. And a big factor is China. Their expected production cuts haven't fully happened, so Chinese exports are still high, putting pressure everywhere.
Right, the China factor is always huge in steel.
Always. Plus, regional issues, demand in the EU is a bit weak. The UK economy is fragile. Broader economic uncertainty, policy shifts. These are all risks. And, it's important to state, these are projections, forward-looking statements. Actual results could be different.
Understood. But balanced against those risks, what are the big opportunities they can seize?
Plenty of opportunities, too. Long-term, the earnings picture looks clearer because of these big structural changes. The EAF transition in the UK is fundamental, expanding into more specialized, higher-value steel products. And that strong domestic demand in India is a huge tailwind. Specific projects like NINL, Kalinganagar, ramping up these are seen as things that could make the market value the stock higher, those re-rating triggers again. The UK EAF should boost profitability there. European spreads have actually improved a bit recently.
And the cost program.
That's a massive ongoing opportunity for better margins. And underlying it all is India's growth story, government spending, rising incomes that drive steel demand. So overall, their focus on boosting capacity, running efficiently, adopting green tech, and allocating capital smartly, it positions them pretty well, despite the challenges.
Okay, so let's try and synthesize all of that. What's the big takeaway message for someone trying to understand Tata Steel right now?
I think the key takeaway is this. Yes, they had a bit of a dip in volume and revenue in Q1 FY26, short-term stuff. But crucially, their profitability jumped significantly. And that was driven by getting costs under control, the first real fruits of that big transformation program.
Right.
And their big strategic bets, the UK's green transition with EAFs, expanded capacity in India, those are powerful long-term drivers. They set the direction for the future.
So what does this all mean going forward? What should we watch?
Well, despite those potential short-term price pressures, falling coal costs should provide some help, and demand might pick up. The current valuation looks, fairly reasonable compared to future projections. So considering the strong Q1 profit, the ongoing cost savings, the strategic moves in the UK and India, and that long-term push for greener, more profitable steel, it really seems like Tata Steel is navigating a tough global market pretty effectively right now.
That was a really insightful deep dive. It really is fascinating watching them try to balance today's financial realities with these huge necessary shifts towards a more sustainable, perhaps more profitable future.
Absolutely. And it makes you think, doesn't it? How will this global push for decarbonization keep reshaping industries like steel? What other kinds of innovations might we see pop up in response?
Definitely something to chew on. And just before we wrap up, a very important point. We are not SEBI-registered financial advisors.
That's right.
This discussion is for informational purposes only. If you are considering any investment decisions, please consult with a certified financial advisor. Great. Thanks for joining us for this deep dive. Until next time.